review session for, I guess it's Lab 3. It was for Monday, June 27th. I posted two different examples of cash flow analysis that follow along with what we just did in the chapter, where we take a look at where the cash flows actually come from. And the key to where they come from, of course, is to take a look at the revenues coming in, the expenses going out, try to figure out what's left over, because that we can actually say belongs to the project. If it's cash that is not coming in or cash that is not going out because of the project, we don't want to include it. So there's a list of things we don't include, which would be things like overhead costs. If the president's salary is staying the same, even if we take a new project, we don't want to put any of that cost in the project because we would have to pay it anyway. So we want incremental costs. A couple other things to note on the list. One is opportunity cost, and so that's going to come up in both examples. The opportunity cost type argument is that we want to make sure that we include the true cost of things. So if we are getting some kind of a special arrangement where we're getting warehouse space for free, essentially, we want to include the cost, the true cost of that space, because nothing really is for free. And so the second example has the opportunity cost of space, which is that the warehouse space is being rented to someone else. And then if we're going to use it, that means we give up that rental. So one way you could look at it is we have to earn at least as much with the project as we would earn from the rental. Another way of saying that is to take a negative cost for what we're giving up and putting it in as a true cost, and then saying we should take the project if it has a positive NPV. If we do that approach, we're building in the fact that we're losing this rental. We're building it into our standard analysis where we look for a result that says positive NPV. All right, so that's one way to think about it. The other opportunity cost type argument is to think about what happens if we offer a new product and we lose sales of the old product. Or we offer a new product and we gain sales of the old product. In that case, by doing the new, we are adjusting something about our current business. We want to make sure we include that. That's what the first example is about. Well, actually, I guess I'm going out of order. I want to do the desk chairs example first. And in the desk chair example, in the question, it is all about the fact that we're going to come up with a new chair, and this new chair is going to cause us to lose sales of the old chair. Because right now our company makes this same old chair we've been making for a long time. Think about a desk chair, kind of like fake leather that leans back, that kind of thing. We make the same old product. We've come out with a new version that's more expensive. It has speakers in it so that it and sort of controls so that it's high-tech chair, I guess you could say. And we expect that when that comes out, we're going to lose sales of the original chair, and we need to build that into our analysis. Otherwise, we can make a bad decision. So that's what question 2 is all about. So I want to walk you through this because it's pretty straightforward. It again just goes through the basic techniques of breaking the cash flows into the 3 categories, which is the investing category, the initial investment, as adjusted for salvage value. We also have a working capital piece because we have money tied up in inventory, accounts receivable, accounts payable. And then it has the operations piece, which is the heart of the analysis. That is the revenues from the project minus the expenses of the project. Okay, so we have all the different pieces. We're going to take a look at them in this project. Okay, so this project, what we're given is some numbers for what we think is going to happen due to the new project. And one of the twists that I like about this example is that our numbers are not a guarantee for what the sales are going to be. Instead, it is a probability distribution. The pessimistic opportunity or pessimistic result is that in year 1, 2, 3, 4, we will sell 10,000 chairs. There's a 25% chance of that happening. There's a 50% chance we will sell 20,000 chairs and a 25% chance that we will sell 30,000 chairs. And the reason for having the probability distribution is because we really don't know what will happen. We are forecasting now, and in a lot of ways it makes sense to forecast, assuming that our share could be a much bigger hit than we're expecting, or a bigger loss. So this allows for that. We're going to cover this in the next class, where we take a look at what-if type questions, and this is one way to handle it. We're going to see is Monte Carlo simulation, and the simulation would be we build a probability distribution for what the sales would look like, and then we randomly simulate what happened, and do that a whole bunch of times, and we get a really good sense of what the outcomes look like. So the way we're going to handle this is just by doing a simple expectation payout. Right, the expected is going to be the probability times the outcome. So if you take the probability times the outcome plus the probability times the outcome, we have an expected of 20,000, which is our normal case scenario. All right, in doing capital budgeting, you always want to use your best case, or you want to use your expected result, which is not going to be the most extreme positive or the most extreme negative. It's the one in the middle that you think is most likely. If we think about a probability distribution, it is the mean of the distribution, which is the same, is essentially the average. So we're going to use our average outcome, and that's what we think is going to happen. Okay, so just a little twist I threw in just to kind of show you some of the dynamics here. So once we get our expected outcome, we can then do some numbers. The other thing we have is the expected sales of the old chair, and we note that we expect to lose 5,000 sales of the old chair if we introduce the new chair. So right now the old chair also has 20,000 chairs expected. So what that means is if we build both, we expect to sell 20,000 new and only 15,000 old chairs. Because yes, we're expanding our market, with the new product, but we're going to lose sales of the old product. Then I give some other details. Variable costs are 50% of revenues. Fixed costs is $250,000 for the new chair, $500,000 for the old chair. The reason the old chair has higher fixed costs is that presumably it is run on older machinery. There's a lot of the costs that go with it that would fall in the fixed category that end up being higher. Working capital is 10 years of next year's revenue. It costs $500,000 in research to develop the new chair. The discount rate is 10%. So then find the net present value of the project. Okay, so those are the details. So here's the solution that I posted, and the solution is posted now. I don't know why I can't make those others go away here. There we go. Okay, so the okay, well, I'm going to have to restart this because that was definitely a problem.